Hello, and thank you for tuning into the Money Wisdom Question Series powered by Johnson Brunetti. My name is Jake Dozer. I'm a certified financial planner and a certified private wealth advisor with the team at Johnson Brunetti in our Connecticut offices. And I'm looking forward to our question today. The question we have in front of us is, how do I avoid tax bracket creep in my situation? Well, let's first define what is tax bracket creep. Tax bracket creep is, as the name suggests, when over time, slowly but surely, as one increases their income, which is what we all hope for, over time, is next thing you know, you're finding yourself into a new higher tax bracket. Tax bracket creep on the way down is no problem, so we won't talk about that today. But that is a very real thing. Typically, as people, especially in their late 40s, early 50s, and even into their 60s at times, are in the place where they've positioned themselves well. Their career is taking off. They're at a place where maybe they're earning more money than they ever have. Well, in those times, you need to evaluate your tax circumstance now versus what it will be in retirement and determine when is the best time for me to pay taxes. What's the greatest lever that we can pull in order to facilitate that? Well, if you find yourself and you're earning substantially more income now than what you think you will be doing in retirement, well, then the old tried and true method of lowering those taxes via 401k contributions is going to be most powerful. Specifically, what you want to look at doing is making pre-tax contributions in order to lower your taxable income now so that you can curtail that. You can also look at things like grouping together charitable contributions. Maybe you are somebody who gives to your local church or your charity. Well, right now, with standard deductions as high as they are since 2018, it's very hard to write off charitable contributions on a tax perspective. But if you can group your charitable contributions together, maybe instead of doing a little bit every year, you do one every 3 to 5 years, it allows you to write off enough money to actually raise your itemized deductions to the place where they're bigger than a standard deduction, and that can bring your taxes down. That is something you should be working with in concert with your tax preparer and a tax planner, such as a CPA or a financial advisor. We'd be happy to help with that, and I hope that this Money Wisdom question series helps in controlling the taxes that you can have. So if you found today's content was helpful, be sure to give this video a like, share it with somebody else who you think may benefit as well, and we'll see you next time.